Hi all, and welcome to Brick by Brick, the podcast for the property development industry. My name is Ian Humphreys and I am a co-founder of Brickflow and one of your hosts. Each week we'll be speaking to experts and stakeholders from across the property development sector. We'll share ideas and advice on how to get ahead of the game as a developer, as well as trends and insights from across the sector. The series is designed for all experience levels. Whether you're just starting out on your property development journey or you're an industry veteran, we'll handpick topics with universal appeal so we can all continue to learn. We'd also love you to share the podcast with your development industry network. Our mission through Brickflow and the podcast is to make development finance better. Every year, somewhere between a third and a half of all SME property developers cite lack of finance as the main reason they don't build more. It's only through raising awareness of the problems that developers face that we will improve. The more people will hear this, the more the industry will pay attention and the better it will become for all of us. So please share as far and wide as you can. We also really want you to join the conversation. If you have any suggestions for future topics or guests or thoughts on any of the podcasts, we'd love to hear from you. Get in touch through LinkedIn or Facebook or email us at podcast@brickflow.com. I hope you enjoy the show. Welcome to the show. This week, I'm delighted to welcome Callum Ferguson and Matthew Tucker from Alpha Property Lending. Now, Alpha is probably not a name that all developers know, but they should. They're well established and well funded. They're strong in residential development finance, but also in the commercial sector, both for development finance and investment finance. Let's find out a bit more about them. Welcome to the show, Callum and Matthew.
Hi, thanks for having us.
Morning, Ian. Thank you very much.
Thanks for coming, guys. So we want to start the show with you introducing yourselves. Tell us a bit about your background. Why do you love what you do? Do you love what you do? Callum?
So I started out in the property sector. I actually studied urban land economics up at Sheffield, so a mix of real estate and economics there. Had a slight hiatus in the financial crash and went out to coach football in California, and then followed my true passion and started my real estate career in 2010 in London. I did a couple of different roles, including land acquisitions, office acquisitions, and also at a JV equity funder. And then prior to joining Alpha in 2019. At Alpha, we're predominantly responsible for cradle to grave from loan origination all the way through to repayment. So we find the deals, structure them, monitor them, and take them all the way through to hopefully a successful end.
Perfect, thank you. And same to you, Matthew.
Yeah, so I'm a lending director at Alpha Property Lending. So same as Callum, full cradle to grave from origination, loan management, and repayment at the end. Been doing that for the last 4 years with Alpha. Prior to that, I worked at BLME, which is one of the challenger banks, which many people haven't heard of, but they are a Sharia compliant lender based in the city. And prior to that, I was working in various roles, including doing town planning straight out of university. So I did that for a few years as well, and that sort of gave me a bit of a grounding in some of the other aspects of property. In terms of why we do it, what we like about it, I think I can't speak for Callum, but it's the people really. It's everything. It's all the people that you meet in the daily job. Also, having properties in the family for me. My father's a QS. My brother works in construction as well. Some of my memories as a child were being taken to building sites as well. So it's something that's always been present in my life. So it's always going to end up here sooner or later.
There's also a sort of feeling of legacy with property development, particularly, seeing a patch of ground or a derelict building turn into sort of brand new apartments or somewhere where people go to work or trade. It gives that feeling of legacy that you've played your however small a part in it.
Yeah, no, 100% agree with that. I think for me, it's definitely the people as well. Like nothing's the same, no deal's the same, no person's the same. How they've got there, how they've become a property developer is always really interesting to me because, no one leaves school to be a property developer. You kind of find your way there. And everyone's path is different. So, it's really interesting. I think you've hit the nail on the head there with the people. Okay, so we know more about you now. Can you tell us a bit more about Alpha? You're not a bank. You're part of what we call the non-bank lending sector. So how are you funded? How big is the loan book, and what are the types of deals that you do?
Yeah, I mean, so Alpha is funded through two strains, really. We're a mixture of institutional capital and funds that are raised through a network of IFAs. So the important thing about Alpha really is that all of our capital is in-house. So we make decisions on how that capital is spent. We don't have to make cash calls with other lenders or anything like that. So we're 100% an in-house sort of organisation and lender.
You're in control of your own destiny then.
Absolutely.
Perfect.
Yeah, I mean, in terms of the loan book itself, it currently stands at about 350 million, which has been a steady growth period over the last sort of 5 years, and that's sort of starting to get to the point where we're seeing some of those earlier loans repay. We're having more loans come in as well. We're getting that churn now to a point where we're starting to feel quite established. I'd say of that sort of 350 mil, probably about 80% is in development finance and 20% is investment finance. Covering everything from offices, sheds, care homes, hotels, everything like that. I think in the future we might seek to sort of balance that out a bit.
Yeah, absolutely. I think over the next 12 months or so, we'll certainly be looking to grow the book by, circa 15 to 20% across, the various different sectors that we're working already. Slightly caveat that with the unusual times we're currently living in and all communicating via Zoom rather than the coffee shop that we're used to. So, but that's certainly the desire for the business to grow.
Perfect. Okay. I mean, just to put that into context for people listening or watching, another 20% on 350 million puts you close to 400 million. And I mean, there's quite a few challenger banks that wish they had that kind of size loan book. So, I mean, you are a really serious player in the development finance space.
Yeah, absolutely. I think Alpha, the sort of mantra is that we really are a relationship lender. We want to do repeat deals with the same customers, with the same institutions, the same partners, one after another. So we really want to be here for the long term. We're not trying to, take over the development loan market in 2 years and be a flash in the pan and then sort of go down in a blaze of glory. We really want to be here for the long term and sort of build those long-lasting relationships. I mean, the non-bank sector is something that's really exploded out of the last financial crisis with the sort of constraints put on the traditional high street lenders with regards to real estate development. It just wasn't serving the needs of property developers at all. So this challenger bank and alternative lender sector has really, really gathered pace. So now you've got people who are, getting funding lines from all sorts of weird and wonderful places. And it's really shown a bit of innovative, thinking in a sector that has always been, predominantly on the spreadsheets and the abacuses. And I sort of know that from somewhere that's been a kind of a peer-to-peer equity partner previously, it's really amazing now that the sort of variety of ways people can find a way to service the capital stack for property development.
Yeah, I mean, there's plenty of choice out there, and I think innovation is key. I think people really have jumped into the space that was left by the banks. I mean, the growth of the non-bank sector is one that's fascinating to me. I mean, for those listening, when we speak about the non-bank sector, we're typically referring to institutional capital from pension funds, insurance companies, sometimes sovereign wealth, as well as family offices. If you look back to 2008, the data seems to suggest that all commercial real estate deals in the UK were done by the big banks, by the names that we all know. Whereas in 2019, according to Cass Business School, 54% of all commercial real estate lending in the UK was done by non-banks, which is why it's really important to not just speak to the well-known high street lenders. Technically, they are now a minority in this space. If you're only speaking to high street lenders, then you're actually only speaking to less than half the market. But to put some numbers to this achievement by non-banks, in 2019, the UK commercial real estate space was around 65 billion of lending, and that's across bridging, development and commercial investment. The 54% is circa 35 billion. we're talking zero in 2008 to 35 billion annually in a little over 10 years. And that's a huge shift away from the major banks. What do you guys put this down to? Is this been deliberate? The banks actually retracted? How do you think these newer lenders will fare going into a downturn as well? Because most of them have only known the good times, an economic upside.
Well, to sort of take the first part of that, where this has come from, I mean, there have been some massive capital constraints on the main high street lenders, and it's fair to say that it's not necessarily that they don't want to lend. It's more that there are so many restrictions that they can't always lend on the things they want to lend on. So that's sort of one element. That means that there's then an opening in the sector for challenger banks to come in, and we've seen that, and we all know sort of who those main players are. Alongside that, there's also an increase in desire for gearing that perhaps has been again this sort of retreat from that sector from the main from the usual sources. When you've got that, you've got challengers stepping in. You've also got other elements of the non-bank sector, so mezzanine lenders, for example, or we're seeing a lot of third-party equity providers as well, just able to help to give that extra leg up into that extra bit of gearing that might make the difference between making a deal profitable or just completely unachievable. So that's sort of like the first element. In terms of how those lenders are going to fare going into a downturn, I mean, I don't want to sort of sit here and say we are definitely ploughing straight into a downturn now.
Sure.
But just sort of with everything that's going on in the wider market at the moment, and obviously we'll talk about that later. But it's about sort of being conservatively prepared in the first place. At Alpha, we try not to lend money willy-nilly. We're not just sort of desperately trying to build a book. I know we talked earlier about that 350 million. We didn't just go out and say, right, we're going to write every single ticket we can. There are certain sectors which are very difficult to lend into, and there are very good reasons for that. You don't want to have been piling money after 2014 into high-end London resi, for example. It's not something where you want to be going up to the traditional levels of sort of 60-65% loan to GDV.
Yeah.
How those non-bank lenders are going to fare now will depend entirely on how they've prepared over the course of the last few years. For those that have been trying to lend to the right clients on the right deals in the right sectors, they should be adequately prepared going forwards. For the other sectors, those who've been trying to aggressively book build, we can expect to see those funds stepping back from the market, maybe having a rethink about how they want to tackle things going forwards, and in some cases pulling out altogether. We've already seen that with various peer-to-peer lenders as well over the course of the last 12 months, way before COVID-19 struck. So there's definitely a shift that's going on anyway. And that's really part of almost like a life cycle. You will have those lenders which are inadequately prepared when things go wrong. They will have to step back, and unfortunately, the people who get hurt when that happens are those who invest in them on the peer-to-peer side. That's people sort of ploughing the money in, and those who borrow from them. And it's unfortunate, but that is probably what's going to happen.
Absolutely. I think with the number of different capital streams we've seen come in post 2008 and post, people just going to the high street for their loans, those people who have invested always want to see their money back is the golden rule. So if we do go into a downturn, then people will be put off maybe by investing in real estate development again, or will be a little bit more fastidious about choosing their timing and what I'd say may be difficult to access as much sort of capital as previously. But the flip side of that is that money in the bank sector is extremely cheap right now. So if you can protect your investors' capital, at least during this sort of period of uncertainty, I mean, those who survive will be really, really in a good place to build going forward, because everyone is going to be sensible knowing that things are going to take longer now. So if you can take the steps, protect your investors' capital and sort of make sure that, no one's losing the shirt off their back, I think there'll be a really strong opportunity for the sector to thrive once we get through this, hopefully, a short sort of blip in the current market.
Yeah, I think you're absolutely right. I think if the lenders that have the higher cost of capital and have been having to chase higher risk in the last sort of couple of years to sort of build a book are definitely the ones that are going to become unstuck now. And I think, consolidation is probably on the cards with some lenders, and I totally agree with your point, Callum. I think those that come through this and come through it well will definitely profit going forward. Okay, so moving on. Can you share the type of deal you're looking for as a lender? What do your ideal deals and ideal clients look like?
I don't really think you can have the ideal deal without having the ideal client. It's very much a relationship industry. There's, sort of building on what Callum said a moment ago about how those who come through this will be well positioned to sort of capitalise going forwards. The banks and the lenders who look after their clients are the ones who will have those clients when the time comes. When those deals are there to be done. Whereas the banks that sort of step back now won't have the clients when the time comes. It's kind of common sense, really. So with that in mind, we don't really want to be working with people who are new to a given sector. If we've got someone who brings us a residential development transaction, for example, we like to see that they've done a few already. And the reason they're coming to us is because they want to build a relationship with someone who can sort of stand behind them. We've got clients that we're doing the sort of third, fourth, fifth deal with, because we don't want to just do one deal and then move on, because there's no merit in that. We want to be here for some time to come yet. And the only way we're going to do that is by lending repeatedly to the same people. That doesn't mean that we can't accept new business coming in. It just means that if we are looking to do a deal with someone, we don't just want it to be that flash in the pan, that first one, and then they're off to do something somewhere else more exciting with someone else. We want to be doing sort of a fairly boring, really, just everyday transactions where we know that we can get that repeat business again and again. So, for example, if it was residential, sort of 20 apartments in a block somewhere, all Help to Buy, all going to sell very easily to first-time buyers. Perfect, that's lovely. But can we do one of those, and then we'll fund your next one, then we'll fund your next one, and so on and so on and so on. And we hope that in that way we can assist a property developer to grow in their ambitions as well, but sort of like on a very sort of organic level, rather than jumping from doing a householder extension to doing that 20 apartment block to then doing sort of 300 houses somewhere. So it has to be sort of a more of a steady growth, really.
Yeah, no, I think, we sometimes speak to people or see people that have done a loft extension and side return and now want to build 10 houses, and
yes,
it's not quite the same thing.
We see a lot of that as well.
Yeah, no, I think the gradual building is brick by brick, I think is the way to term it. Okay, so I mean, I can vouch for that. You are very much a relationship-driven lender. What do you think sets yourselves apart from the relationship? Because I think a lot of lenders will probably try and use that. Is there other things that people might think, or we might think, Alpha are the best people for this? This is their USP.
Well, absolutely. I think, what we mentioned earlier, in the sense of that all decisions are made within the four walls of Alpha with us. We don't have to go out to external boards or, anything like that. So we can get a gauge on whether a transaction is going to be, one for us to pursue quite quickly. That's not to say our credit process is slapdash. We're very, very, sort of diligent, and some of Matthew can attest. Some of the credit committees get a little bit feisty, but we can get that. We can get buy-in from the main decision makers or not very quickly, and that allows us to zone in on the right transaction with the right people. Quite early on. Of course, there are, some things are not always what they seem, but that's part and parcel of the industry. And I think we talked a lot about the challenger bank sector and the sort of how things have changed. We are very much in the alternative lender space, but we kind of want to flip it back to the old school bank manager relationship where you can pick up the phone to your relationship manager at Alpha, and that's the person that you deal with no matter what stage you're in. You're not put off to portfolio management or to another team who haven't met you before to go through the construction stage. We're there all the way through, and that way we can sort of hopefully work together to come over any problems that arise, or to get on to the next deal. So it's sort of going back to the old school principles of banking, as well as whilst filling the alternative space.
Definitely, I'd completely agree with that. It's something we've been sort of quite keen to do, is to make sure that when you pick up the phone and you phone me, or you phone Callum, or you phone anyone on the team, that's the person that you end up speaking to. You don't go to a call center, you don't go to a middle management, loan management area or something like that. It comes straight to us, and we can then deal with whatever that query is, hopefully fairly quickly. So that's sort of one of the key things. Another thing, sort of part of that really, is that because we are all making our decisions in-house as well, we can move very quickly, and we have in the past turned deals around from first approach to getting the money out the door within sort of, I hesitate to say this, we've done it within 10 working days. That's not an advert. We don't like doing it in that time scale.
I mean, that's phenomenal to be able to turn around that workload in that time.
I should caveat that. A typical
we understand.
A typical turnaround for us would be sort of 3 to 4 weeks. That would be normal. That gives us time to go through all the due diligence, do everything
That's
properly.
still really quick though by industry standards.
But if we do need to drop everything else and get it done, we can. We would just rather not.
I agree. So the headline is 10 days development finance.
No, not the headline.
All 10-day inquiries to be forwarded to Matthew Tucker, I would point out at this point.
It's going to be a busy 12 months, isn't it?
Yeah. So, so where do you think there's flexibility in your lending criteria, and conversely, where do you think you're perhaps more rigid?
We're sectors we're quite flexible on at the moment. We sort of look at industrial, office, care homes, that sort of thing. Personal guarantees we can potentially take a view on as well, depending on the client, the situation. I think we always look at the lending package as a whole package. So if one area doesn't hit the specifics, then we can maybe compensate elsewhere. The things where we're a no-go really is we don't lend to retail at the moment at all. Also, what we don't like is micro units. Some of the things that have gone up in Croydon over the last few years, and areas like that of units that are studio micro apartments that have difficulty in mortgage markets, and they have it at the right time sold very quickly, but it's not really something we want to be involved in. We prefer to have a good unit mix. So micro units is always a no-go. And one of our golden rules is that we always like the developer or the borrower to have 10% of total cost in the deal out of their own pocket. So to have that skin in the game, that cash to protect, because really, the borrower is the most important thing in all of this. The real estate is obviously important, but you've got to be in bed with people you trust.
Just to sort of build on that, really, if someone has an aversion to offering a personal guarantee, and we do come across that, but they're prepared to offer us a charge over an unencumbered property instead. That's something we can consider. I've even seen people try to reduce the value of their personal guarantee by offering cash on account. That doesn't work for everybody. And I can understand why many people would sort of go, why on earth would you do that?
I know,
but it works. And,
for some people, it just works conceptually.
Yeah.
Yes, exactly. Yeah. And it's really just what it needs to get over the line. Like Callum says, we try and view the deal in the round and then find a way to make it work, rather than sort of say, oh, well, if you can't do that, then we can't lend, because it's just not really constructive. It's not conducive to getting work done.
I think that's exactly the right attitude to take. I think that gives us a really good overview of your offering. I now want to speak a bit about the current development market. I don't want to dwell too much on coronavirus. I think we all hope that it's a temporary thing, but undoubtedly it's going to have some immediate ramifications as well as some long-lasting impact. How do you see the market playing out over the next 6 months? But more importantly, once we're through, what do you think the next few years hold for property developers?
Yeah, I don't think anyone can have a conversation now without sort of mentioning COVID-19, unfortunately. Nobody's got a crystal ball. We don't know what's going to happen, certainly in the short to medium term. And I think there are plenty of market commentators out there who are giving their opinions on it. But at the moment, really, it is just opinion. As we record this, we don't actually have a roadmap out yet. Obviously, that's going to change this weekend, so it could change everything we're saying now. But I mean, over the sort of the medium to long term, we will have a housing shortage in this country until we start building huge numbers of houses and loosening up the planning system to go with it. At the moment, we have a very supportive government, even allowing construction workers to go to site at the moment, controversially, with coronavirus rampaging through the land as it is anyway. So it's good to see that we have support in that sense. We've also got Help to Buy, and I know that there's a lot of controversy around that at the moment, and whether that's going to be extended or amended. And we'll just have to wait and see what happens on that front as well. But it's quite clear that at policy level, there is an acceptance that there is a need to build, and there is a need to provide housing for our population. So what does that mean for developers? I think it means that whilst there will always be that demand, we are certainly seeing a flight to quality. We're seeing that purchasers expect something extra when they're buying, whether that is a car parking space, whether that's a patio, a winter garden. We're seeing quite a lot of that in sort of central London developments as well. They're expecting that little bit extra to make it different, to give it some character. And I think that's probably only a good thing. It means that there's better quality developments coming online. If you were a developer right now and sort of trying to think, well, how can I use that to my advantage, or what should I be thinking about? Some of the things that we're starting to see is people building in bigger contingencies into the construction, just to cater for some of the variations that might be required as construction unfolds. But that has a knock-on effect, because it means that if that cost is going up, then obviously that profit is being eroded. So I expect to see over the course of the next 12 months a lot more aggression in terms of trying to drive down the prices of the land in the first place, just to try and get to that point where that profit is still as safe as it can be. So we might see a change in that sense as the profitability goes out of the land pricing, or maybe just some improvements in terms of the planning. We're also seeing a lot of airspace developments as well, which again, a lot of people have mixed views and mixed feelings about, but there's going to be some changes in that sense as well.
Absolutely. I think you may see, from a residential development standpoint, maybe more overages being used in terms of acquisition price, so that people can protect the value should development succeed, whereas making it viable from a starting point in a less favourable market conditions. So you may see that more commonplace, more creative ways of completing acquisitions. I think there may be less hanker to live in the cities now, as long as we can remember in recent times, particularly. Sort of, I hate the word, but because I am one, millennial generation want to be, close to everything, so they can pick up avocados from the market and go home and be close to the office. That may change with this current pandemic. There may be people want to work outside the cities more. But that will have to wait to be seen how transport and different things evolve around that. But certainly, I think you will see more people wanting to live out in the country. As a house Alpha, we're looking to move, into sort of some of the core areas we think are great for residential development, like the southwest of the country, southeast, areas around the Midlands where, people will want to go and live to get that extra space. And, with technology like we're using now, I think you don't have to be living in Shoreditch to work in the tech industry. You can be you can be somewhere else. So that may change. We'll also be looking to diversify our book in house. We do see the residential development as our bread and butter, but I think certain other sectors will flourish out of this as well. Industrials, warehouses, or sheds, whatever you want to call them. We've got some we're funding at the moment in East Anglia. They're going very well. I think that's going to be something where more and more footfall will move away from the high street into online, shopping more than ever, and those places will need places to be stored. So that will undoubtedly happen. And there'll be some casualties as well. I think the retail is really struggling. I think that will be offset by the growth in other sectors, and it'll be really interesting to see how the office sector looks after this. I think you may see a move away from highly density CBDs and maybe some more regional offices and more sort of piloted space, which have all been turned into permitted developments in the past 10 years or so. So that will be a real opportunity for people as well, I think.
Yeah. No, I think the advent of technology is interesting, and this has only brought it to the fore more. I think there are a lot of people that perhaps work in more traditional industries where they think that everyone needs to be in an office all day, every day for the company to work. And I think this period of time has probably shown everyone actually that you can work from home, and pretty much everyone I speak to is enjoying the pace of life a bit more at the moment. It's a bit frustrating perhaps to you can't sit face to face with people, and there are some downsides to it, but not sitting on a train for an hour, 2 hours every day like some people have to is probably a huge win to mean that they can see more of their kids and spend more time at home. So I think longer weekends, people sort of perhaps only coming into town Tuesday, Wednesday, Thursday, or maybe even less frequently, in which case you don't mind living in Somerset and commuting to London if it's only going to be once or twice a week. So I think there's some huge shifts in our thinking and the way that we use our space.
Absolutely. I don't think we've certainly seen the death of the office by any stretch. I think this period will make people hanker after it, a bit as well. And I think you're right that habits will change somewhat undoubtedly because of the solutions that we're sort of, even people like Matthew and I, who certainly are very much in the office kind of people, using this, we're sort of forced to learn to work from home properly and effectively in this period, and it can really be a positive for everyone. So.
Yes, I was reading something recently that said that post 9/11 there was a sort of a flight away from cities, from those who could left the cities to move into the countryside, and there was a sort of a bump in property prices as a result in sort of all the home counties and the typical sort of commutery areas that you would expect. And what I think is going to happen here is obviously that sort of petered out, and then Callum mentioned a moment ago the impact of the millennials wanting to come back into cities for various reasons, and mostly to do with just convenience. And I think what we've seen here is that everybody's sort of having to work from home, and people are going to be sort of saying at the moment, well, maybe my home isn't big enough. Maybe working from home doesn't work for me here, but it might work 20 miles down the road, 40 miles down the road, whatever it has to be, where I can actually have a bit more space, a garden for the kids, or a spare room I can use as an office, or whatever it happens to be. So I think whilst we sort of saw that little jump after 9/11, with this sort of coronavirus that we're seeing at the moment, what we might see is a sort of a more pronounced spike, and possibly with a longer tail on it as well, actually having more of an impact over a longer period.
Yeah, no, I agree. I mean, as a lender, if somebody comes to you and says we're building, 2 really big houses in the middle of nowhere, that's obviously less liquid, but based on what you're talking there, that could be a trend. Do you sort of think that's something you'd willingly support, or do you think you'd actually want to see how it plays out?
I think it depends what you mean by a really big house. I think we have funded things where we've had sort of a terrace of 4 semi-detached houses selling at the right price for the market in a strong town outside of London. That sort of thing can work. But if you're just saying I'm building 2 large detached houses in the middle of nowhere and there's no established market, but we reckon people are going to come here.
Yeah, you're not going to.
I don't think that's going to work.
Yeah, no. Okay,
there are other lenders who can take that risk, I think.
Yeah, no, I'm sure there are. Well, if they're still standing. Okay, one thing I like to ask lenders, if there's one thing you could ask your borrowers to do every time when they apply for finance, what would it be? Perhaps one from each of you.
I think for me, the bugbear that really gets me is people say that they want to borrow a certain amount to build something, but then don't tell me how long they think it's going to take. And people forget that the money has a time value. And I need to know how long you think it's going to take to build it, how long you think it's going to take, how long do you think it's going to take to mobilize first, then how long do you think it's going to take to build it, then how long do you think it's going to actually take to sell it? And that last part is so crucial. And people sort of come to me and say, well, I reckon I can sell these, use that example from earlier, the 20 odd flats in 3 months. And you think, well, okay, but how? What's your strategy? How do you intend to do that? It's going to be a bulk sale. Do you have someone that you sell to regularly, or do you have someone lined up to step in? What do you intend to do? We're not asking for pre-sales. We're not asking for a detailed strategy, but just to have some idea, some thought that's gone into how you're going to sell them at the end. And also, if that construction period does get stretched out, which I think we're going to see a lot more of, we are already seeing shortages in materials and labour. What's going to happen if you overrun by 2 months, 3 months, 6 months? In some cases, it's not that unusual. If you're going to come back to us and say, okay, well, look, I'm going to need to extend, you should be thinking from the outset what that cost is going to look like for that additional cost of money, because that does have a cost implication. It does mean that your profit is going to be eroded further in terms of finance costs. And if that makes the deal unviable, if that's the difference between yes and no, it's a hell of a risk to take. And we have seen schemes where profit has been slowly eroded until actually there's very little left for the developer at the end of the project. And that is a real pity. That's not something you ever want to be involved with.
Yeah, I think some developers, don't seem to understand the time differential that it has on the day one land loan. So kind of as you've just alluded to, they say to you that we want this amount of money, and you ask how long is it going to take to build, and they say 15 months, and you say, well, I can't give you this amount of money. Oh, I can build it in 12 months. And they kind of, it's almost, I'll shorten the build term so I can get a bit more money. And like you say, that you sort of
turning the screw on the contractor.
Never a good ploy. And
exactly.
You, Callum, I feel like it's a bit like blind date. One from you. What you, Callum? What?
Thanks, Graham. I think transparency. Transparency for me, funny with blind date, but transparency is the most important thing with regard to the developer. We really are kind of warts and all organisation, as horrible as that sounds. We really look at everything, as clearly as we can. And I think if there is a problem, we can usually find a way around it if the fundamentals of the transaction, and the borrower are good enough. You'd be amazed the amount of inquiries we get where, within 2 days we've had a quick search and have found, adverse financial history on people. And if we're not told, it really does make it something that we don't want to do. Whereas if someone comes to us and says, I had a real terrible time in 2008, with the rug under me, and I've got this bankruptcy on file, but it was because of X, Y, and Z, and we collaborate that, we have lent to those kind of people. We've had to charge a bit more to compensate for the risk, but we have lent to those people and sort of got them going again. So it's really about coming with, transparent, what are the issues, what are the potential pitfalls, and how can we mitigate those? And we can do that together sort of collaboratively. And that really is the sort of way we see things moving forward. And that, through through the whole transaction, not just through the credit process. That's how we like to try and do things. There's nothing worse in property development than people going quiet or sort of, leaving the bad news till the last minute, because, more often than not, that means that puts the final nail in the coffin. Whereas if, things come up always, that's part of life. Those wonderful spreadsheets that we make at the start, it never goes exactly how those are pointed out. We all know that. But I think, that sort of open, honest approach, so that we can hopefully work together and sort of tap into all of our expertise to sort of get a successful outcome is what we look for, and that's for me the biggest thing for people coming to Alpha is just give it to us straight, and we can hopefully find a way to do it.
Just to quickly say, Ian, I think both of these points they come back to the same thing, which is risk. If we can understand as many of the risks as possible from the outset, we can give you the best possible terms going through. If any of these things, we have to find them out ourselves, it adds an extra layer of risk, which I think a lot of people don't necessarily always understand.
Yeah, I think from my side, that it's amazing how often you see it, and kind of almost how naive some people can be, that they think in a day and age where I can just Google your name and 5 seconds later I know most of what I need to know about you, and then they still sort of hold these things back, and it is quite incredible, from as you say, a company's house search, a credit search, a Google search. Now, I can get a pretty strong understanding and know a lot about your background. And I think you're right. It sort of sets you off on the wrong journey. If you're holding, it's like you as a lender, if you sort of only gave people half the story about what they needed to provide, or you said, well, look, we should be able to do a rate of this, and then 2 weeks later you changed it, the borrower would be rightly annoyed. Similarly, but you should expect the same courtesy that when they come to you, they should, as you say, warts and all, and then there's no surprises. So, okay, so one final thing I wanted to ask you both about, and it's really about technology in the sector. So, as you know, through Brickflow, our main reason for being is to try and introduce more technology into the sector, into development finance and CRE more widely. But when you compare it to other finance sectors, I mean, it doesn't really nothing seems to have changed really in the last 20 years. So what, from an application and process standpoint, it's still very slow, and there's no real adoption of technology. I mean, where do you think there are some quick wins for us to kind of, beat the status quo, as it were?
Well, I think one of the things that we like about your model, Ian, is that because you do have that AI that sort of sifts through the models and sifts through the deals to try and get the right client with the right funder, the stuff we tend to see from you means that we're more likely to take it forwards, because we know if we get a deal from you, we know that it's gone through that sort of that first level, that first tier of, will it really fit? So that cuts down firstly on a lot of time from our side, but also a lot of effort, because we have to go through these things quite carefully. And if we know that we've got something from you where it's been through your model, then that really does help. In terms of the actual IT side of things, you touched on it a moment ago. We can very quickly, with a Google search, with a credit search, with whatever it is, we can get everything we need to know about a borrower. And if there is something that we're not being told, we're going to find it out very quickly. So there are things that are going on behind the scenes in that sense. Where I think some people are sort of can't really see the wood for the trees, I don't really think you can always have an AI system or a technology system for having a bank application for a loan. It'll get you so far. It'll capture the main detail, but you've always got to have a point where you sit down with somebody across the table, you look at each other and you say, right, do I feel comfortable lending you the money? And I think that's a point that the technology, I don't think there's, in the near future at least, will ever be able to get to that level of, being able to get that, not feeling, it's much more than that. It's putting all of that information together and saying, right, now we've got in all the info, do we still feel comfortable lending? And that's something that I think is, it's a challenge for the sector. It's something that necessarily has to come about with experience. And it's a difficult thing to capture.
Absolutely. I think Matthew's absolutely right on that point. I think what we touched on earlier with the alternative banking sector, the problem with that is for building any sort of AI kind of model that's going to encompass the whole thing, is that every Tom, Dick and Harry is funded in a different way, has a different return on their money. Capital has different appetite. So you can never put something all encompassing in. I think what we need to do is get to the point where we're sitting down and having those sort of looking in the whites of the eyes. We know it's something that we want to do with what we've seen thus far. And I think certain things that you sent me in the past with like videos of sites, perfect. That can save us 2 days on going out to a site, because Google Earth's great, but it might not have been updated since 2016, and there might be someone growing weed across the road and you don't want to live there, or you might want to live there. Who knows? But you know, those sort of things, videos, that sort of thing can really save some of the legwork. We have to go there anyway, but it's all about getting as much of that boxed off at the right point. And I think, I say, the great thing about property and the sort of the thing that will always hold it back technology-wise, I think, is that it is a people and an opportunity-based, industry, and that's partly why we love it. But also, it does have some certain quirks, and I think the rise of the alternative lender is partly because of the banks went to a system where a computer said no, they didn't lend. So it's trying to find that balance, and I think undoubtedly it's starting to happen, and the more sort of detail and the more that first sift of information that's going out to the various different lenders should help them speed up the process. But I think we're a long way from automated decisions.
No, I agree. I think for us, the way we've sort of viewed it is, I know, and it might be with you guys or one of the other lenders on the platform, and I know a lot of them kind of agree with the numbers. They seem to think that for every one application that they sanctioned, that they drew down on, they'd probably seen another 9 that they hadn't. So the kind of 1 in 10 hit rate. And I think where the way the approach we're trying to take is a bit like you touched on, Matthew, is that when an inquiry gets to you, instead of it being a 1 in 10, hopefully it's more like a 1 in 2. There's just that much, those extra layers or the extra process has been done at our level, so that by the time it comes to you, you can really just concentrate on being a bit more granular on the comps and then the detail and also the people. So I think I think you're right. It's a sector that's never going to be fully automated, but I think there's definitely huge amounts of technology out there that are available in other sectors that we just simply don't use, and it would make all our lives a lot easier, and I think it would make the experience better for everyone as well. I think we could all be a lot more efficient, but it's a slow process. But again, hopefully this current situation might speed some of these things up as well.
I think comparables is something that is ripe for sort of technological improvement. There's data out there, and we certainly as a house haven't found a way yet to shorten that period of us going through lots and lots of data. If something comes up that is genuinely as up to date as what's available, that can plot the sort of recent transactions and actually put in that sort of mathematical analysis for you. If we were just checking that would again save us a great deal of time. So that's something. And I know there are various systems out there, and they're getting better. But that is something that I think would have huge take up from the lender industry, particularly to get that, because it's so time consuming.
Yeah. Just one last point here, I just wanted to make. you said about that hit rate going from sort of 1 in 10 to 1 in 2. At the end of the day, we're lenders. We're here to lend money. We want to lend money, and we have the cash to lend. So we don't really want to be wasting time on the 9 deals, sort of having to say no. We don't, because we don't see anything from that. That's not a productive process. So getting down to that 1 in 2, getting down to the point where actually we're spending more time actually focusing on taking a deal through, underwriting it, and then getting the money out. That is what we want to be doing. We don't want to be wasting time with deals having to say, well, look, it doesn't work because of this, and this. And in some instances, with some of the people we work with, having to say, look, I've actually told you this 3 or 4 times already. Please stop sending me deals. We can't fund yours in out Mongolia, but we only want to fund deals that we can fund. So having that sort of that better success rate, that better hit rate, is absolutely crucial to us. So anything that sort of improves that is all to the good for us.
Yeah. The other thing that we should probably mention is that we are fond of that piece of technology called the telephone. And and the reason I say is if something is, because we're an alternative lender, if something is a bit quirky and but you can see an angle on it that you think it could work, we're always happy to talk through it, before someone else has spent a lot of time putting together a huge application. Because it could be something that won't work. At the same time, it could be something that we think, actually, let me go and speak to someone about that and see how we would structure it and feed it back that way. So I think definitely the human interaction, and sometimes the sort of picking up the phone just to run through things is often the best way to sort of to maybe place a deal which you may not have thought of otherwise.
Yeah, I think there's so many little quirks in development finance and property development in general. The way it works on the platform is that if somebody comes in and matches to you guys, then from there it is very much a sort of still a manual process, in that we speak to you, we build the presentations, and we get the information over to you. But like I say, hopefully by the time it gets to you, it's something that will definitely happen because we've had that conversation and you've told us what the weaknesses are, we've addressed them, and then we get to a situation where you're happy, the client's happy, and it's just a lot smoother process. Okay. Well, listen, guys, thank you both very much for that. I think that was really interesting to sort of get it from your side, learn more about you, but as a lender, but also a bit more about you guys individually, and also what you think is going on in the industry at the moment. So thank you both very much. And
thanks for having us.
Look forward to catching up with you both again soon.
Yeah, thanks for having us. Absolute pleasure. Thank you very much.
All right, guys. Thank
Cheers.
you. Thank you so much for listening to this episode of Brick by Brick, the podcast for the property development industry. It was really interesting to understand how a non-bank works and to discuss with Callum and Matthew the wider non-banking industry. There have been significant changes to the development finance market since the financial crash, and the non-banking industry has been the main driver. I always find it really insightful speaking to lenders in that kind of environment. It helps me understand how they approach lending decisions, which then shapes my thinking with new projects. Hopefully this episode will help some of you listening to think like a lender when you come to doing your next project as well. Anyway, we'll be back again soon with another episode alongside other industry insiders, sharing their own property journeys as well as their tips and tricks to help you get ahead in the property development industry. If you've enjoyed this show, we'd really appreciate it if you would leave us a review and share the podcast with your property industry peers. Until next time, take care.